We talk about inflation. Where will inflation normalize, you think?
Okay, yeah, great question. Our view is we do our calculations and break down what we're seeing inflation. We do find that the current numbers really all are driven by supply chain issues that look like to us they're going to go away in the next year. At the same time, while we think the current drivers that are keeping inflation high now, we think there's going to be new drivers, namely wages and rents that are a big part of core inflation. They do seem primed that they're going to start to rise. So as the parts that come down and other core parts go up, what we target is we think we're going to get inflation back in sort of the 2.5% to 3% in about a year or two, and that's actually a good thing for markets. We spent the last decade with subpar inflation below central bank targets. Getting back to the 2 to 3 range, it will actually be a good thing, especially if it's more driven by wages. Whereas right now it's all just driven by costs, and that's kind of more unsettling to consumers.
Tony, when you take a look at the markets, you can sense, I guess, the concern, the fears. But when you take a look at financial conditions, they've not really tightened. Do you see that happening? And if so, when do you see that happening?
So no, I wouldn't expect financial conditions to tighten that much. What we would expect at this stage in the cycle, and usually when you get your first rate hikes, it's usually based on an economy that's strong enough and expanding enough, and that's seeing credit growth through natural banking loans enough just to continue to keep up financial conditions. And and when we look back at all the prior cycles, there's usually nervousness around the first rate hikes, but it's never been the end of the cycle. Even just looking at the last cycle, which was a rather subpar growth cycle, the first rate hikes occurred in 2016, and all the way through 2019, where markets were making new highs. So it would be a very unusual thing if these initial rate hikes really unsteadied the markets to a large degree and ended the cycle. So I think the market's not unreasonable for being nervous, but it's our view that the expansion should continue, and we kind of remain overweight risk assets like equities.
Well, let's move to fixed income. Tony, what with yields rising across the curve in the US, what's the short end at the moment baking in, and what is the longer end doing?
Yeah, so we were arguing even just last week that it sure looks like the short end has priced in peak Fed hawkishness, that it's pretty much assuming a rate hike starting March and rate hikes pretty much every quarter for the next 2 years. And our view was, well, how much more hawkish can you get? But sure enough, I guess within the past week now, the markets are starting to price in the view that we may even get a 50 basis point hike in March to start off the process. Our base view has been, we're okay with a start in March and, a sustained pace of rate hikes. We pretty much still doubt the 50 basis point start, but don't completely dismiss it. But big picture, as we look at things, whatever the path to the start is, this doesn't look like it should be, high enough rates to disrupt what is a fairly strong economic backdrop. And as long as that continues, we think, the real point of anxiousness is kind of more in a couple of years as rates really get to more meaningful levels.
Well, the world was reopening. We've had a hiccup with Omicron. One would assume that the reopening process is now back underway. But against a backdrop perhaps of economic growth moderating, the thing is that's going to have an impact on inflation, as we've been talking, and certainly perhaps people may well be getting ahead of themselves. What's your take then on what happens with inflation with regards to a moderating global economy after a stellar 2021?
Yeah, so there's several pieces to that. So on the first one about how the pandemic is affecting, inflation and I guess economies in general, we are baking in the assumptions for the next year or two that already we think we've seen the pattern where the pandemic has become less and less influential in markets. It hasn't gone away, but we think that continues. And especially after Omicron, we think there's a stronger case that actually the pandemic becomes less relevant to markets. Obviously in daily life, it's still going to affect how we do things, but markets have already been quite resilient to it, and we think it only becomes less effect. To your point that actually a lot of these pressures are still going to be there that are remnants of the pandemic. I'm very sympathetic to that, especially us being here in Asia. I think a lot of the pressure points that the U.S. is feeling is in areas like travel and airlines and hotels and car rentals and stuff like that. And Asia, we really haven't picked that up yet. And once we do, and once people want to try to travel again, the supply's not there, and those price pressures are going to continue. So I think your point is fair that these pressures are going to linger for a while. And while the academic in me looks at these as transitory issues, I think that wording has been sort of misleading to many in the markets, because while it's not a structural issue, it's a temporary issue, but this temporariness is going to be with us for a year or so.